If you already own a home, refinancing can sound simple. You replace your current mortgage with a new one. But refinancing isn't just about getting a different rate. It's about deciding whether the new loan improves your situation enough to justify replacing the loan you already have. That's what this video is about. Here, we're focusing on rate and term refinancing. That means refinancing to change the rate, payment, loan term, or loan type, not taking cash out of the home. The first thing to understand is your goal. Are you trying to lower your monthly payment, shorten the loan term, move from an adjustable rate loan to a fixed rate loan, remove mortgage insurance, or replace a loan that no longer fits your long-term plan? Those are different goals, and they are not measured the same way. If your goal is a lower monthly payment, the new payment matters. But you also need to know why the payment is lower. Is it lower because the interest rate improved, because the loan term is being stretched back out, or maybe the mortgage insurance is changing or being removed? A lower payment can be helpful, but it doesn't tell the whole story. You also have to compare the payment savings with the cost of getting the new loan. A refinance has closing costs. Sometimes the borrower pays those costs at closing. Sometimes the costs are included in the new loan amount. When costs are included in the loan, the refinance can feel like it has no cost because less money is paid out of pocket, but the costs are still part of the transaction. They're being financed into the new mortgage. That's not automatically bad. It just needs to be understood. When you compare your current loan with a possible new loan, look at the new rate, the new payment, the new loan amount, the closing costs, and the new loan term. Also think about how long you expect to keep the loan. If the monthly savings are small and the cost is high, it can take a long time for the refinance to pay for itself. If the savings are meaningful or the loan structure is better, the refinance may fit your goals sooner. Another important point is that not every refinance is reviewed the same way. Some refinances require a full review of income, credit, debts, assets, and the property. But some loan programs, like FHA and VA, have streamlined refinance options for eligible existing loans. A streamlined refinance is designed to be simpler than a full refinance. Depending on the program and situation, it typically requires little or no income documentation, a limited credit review, and no appraisal. That doesn't mean there are no rules. The payment history, loan's age, benefit to the borrower, and program requirements still matter. The key point is this: before assuming the refinance will require a full document review or a new appraisal, find out whether your current loan is eligible for a streamlined option. Now let's talk about a few refinance surprises. First, your payoff amount can be higher than the balance you see on your mortgage statement. That happens because a payoff isn't just the principal balance. It also includes interest through the payoff date, and depending on the loan, it can include other amounts needed to fully close out the old mortgage. Second, escrow can make the numbers confusing. If your current loan has an escrow account for property taxes and insurance, the new loan may need to set up a new escrow account. That can require collecting funds for future tax and insurance bills at closing. You may be able to include those funds in your new loan, but that will make your new loan amount higher than the payoff amount. Any escrow balance associated with your old loan gets refunded to you after the loan is paid off. That usually happens a couple weeks after closing. Third, closing costs do not disappear when they're rolled into the loan. If the new loan amount is higher than expected, it may be because the loan is paying off the old mortgage, setting up escrow, and financing closing costs. Fourth, a lower payment can come from extending the loan term. For example, if you've been paying on a 30-year loan for several years and refinance into a new 30-year loan, the payment may drop partly because the repayment period starts over. That can help monthly cash flow, but it also increases the total time you spend paying on the mortgage. Again, that doesn't automatically make the refinance wrong. It just means the lower payment should be compared with the cost, the new term, and your goal. One process detail is especially important for refinances on a primary residence. Signing the closing documents doesn't mean you're all done. After closing, federal law requires a 3-business-day waiting period before the new loan can fund. That gives the homeowner time to review the decision after signing. So if you're refinancing, don't expect the old loan to be paid off or the new loan to be active immediately at the signing table. The funding happens after that waiting period ends. The big picture is this: a refinance can be useful when it lowers your payment, improves your loan structure, removes mortgage insurance, changes your loan type, or better fits your long-term plan. Compare it against your existing loan and compare the monthly savings against the costs. You don't need to know every detail before asking questions. You just need to understand your goal and make sure the refinance improves your situation in a way that matters to you. At Texas Lone Star Lending, we believe it should be okay to ask questions. That's why we're your loan educator.